Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about corporations and investing in corporations, when it makes sense, how it makes sense, if you should be doing it, and then also as you enter into retirement, how does that corporate account work? How do you draw money out of it? How do you use that corporation efficiently? And I'm going to share my story, how I use my corporation to invest and to build wealth and to defer tax and all of that. Also, heading into fall, one of the things I love is around Thanksgiving time right now, they release eggnog. So I'm a big black coffee guy, but when eggnog comes around, I put eggnog in my coffee. So if you haven't tried it, don't judge yet. If you've never tried eggnog and coffee, this is your chance, so go try that out. So looking at a corporate account for investing, and all that is you have a corporation, you have money coming into the corporation, you pay yourself a salary or dividends, and I'll cover that in a future video, but you pay yourself a certain amount to put food on the table and pay the bills and all that, but there's extra money left over, and you're not sure if you should pay it out to yourself or leave it in the corporation. I talked to a lot of people that say, yeah, I'd leave it in the corporation, but I'm getting tired of having 100, 2, 3 million, whatever the number is, just sitting in cash in the bank. That's the first place I want to start, is when you have extra money in your corporation that is for long term. You don't need it for short-term expenses or projects or anything like that. This is kind of longer term money that you're just not pulling out of the corporation. You want to make sure you have that working for you. Don't let that money just sit in a bank account. One of my best friends did that for years, 5, 6, 7 years. Like, he wasted away almost a decade of great investing because he just wanted to sit in cash. He had no idea. And even though we told him again and again, you need to get that money invested, he just wouldn't. So make sure if you're sitting on some cash in your corporation that you know you don't need, make sure that gets invested and working for you. And I'll talk about how to invest that efficiently here in a minute. So why leave money in the corporation versus pulling it all out? The biggest thing is tax deferment. A corporation is taxed at corporate tax rates, and depending on which province or territory you're in, it's going to fall between 8 and 16%. So 8% is Alberta. I know in Ontario it's 11.5, BC it's 12. Most fall in that kind of 12% range. So you're paying a much lower percentage of taxes. If I pull that money out personally, I'm paying around 50%. So that's the biggest difference, is if I have an extra 100,000 in my corporation that I don't need, it's for retirement, I can do one of two things. I can pull it out, pay 50% tax, and be left with $50,000. Now let's assume my RRSP and my TFSA are maxed out. So this is kind of money on top of that. I've already pulled enough money to top up my RSP and TFSA for the year. So if I pull that 100,000 out personally, I have 50,000 to invest on a personal level in a non-registered account. So my starting investment is 50,000. Whereas if I leave it in my corporation, I pay 12% tax, and I'm left with $88,000 to invest. So my starting point is much higher in the corporation than personally. So that right there is by far the biggest way. And any account you talk to will tell you, if you can leave money in your corporation, that makes the most sense to do. You're just starting with much more money up front than you would otherwise. Now let's quickly talk about investing in that corporation. I'm going to do a whole nother video on this down the road here because it's quite involved, but I just want to cover it at a very, very high level. When you invest in a corporation, any income that you earn in there, any investment income that you earn is taxed the highest marginal tax rate. And that's where the inefficiency of a corporation, that's where a lot of people say, yeah, but Adam, it makes no sense investing in a corporation because every dollar I earned is taxed at 50%. That's why you want to focus on dividend paying stocks and even better, investments that generate capital gains. So capital gains in a corporation create what's called a CDA account, a capital dividend account. Just like personally, if you took $100,000 and invested it and it went to $200,000, that $100,000 of gain is a capital gain. 50% of it currently in September 2022 is tax-free. Well, in a corporation, it works the same way. If you invest within your corporation, 100,000, it goes up to 200,000. That $100,000, 50% of that is tax-free. And it's credited to a nominal account called the CDA, the Capital Dividend Account. And a shareholder can pull out of that CDA account anytime on a tax-free basis. So it works much like personally. That's why in your corporation, you want to look for investments that generate capital gains, then dividends, and then last is interest income, because that interest income is going to be taxed at that 50% or your highest marginal tax rate within your corporation. So very inefficient that way, but again, because your starting point is so much higher, it creates that efficiency. And again, if I took that 100 or 1,000 originally out and put it in my pocket and have 50,000, if I had interest income, it would be taxed at my own personal marginal tax rate. So if I fall into the highest tax rate, then I'm going to be paying the same amount of tax. Now, if I'm a lower tax rate, I could be paying less tax, but I have less to start with originally. Leaving money in your corporation, not only can you invest it, but it also creates flexibility of paying yourself at a future date. So maybe you have a strategy of saying, look, I'm going to run my corporation until 55, and then from 55 to 60, I'm going to use those corporate funds to draw money out, or 55 to 65, whatever it is, whatever your plan is. You kind of have this pool of money that you can use now to keep paying yourself an income. That's kind of my strategy. Is I build up my corporate investment account right now. I'm letting that work at BCV for me, and they're doing a great job managing that money for me. And ideally, when I hit retirement, my first few years of retirement of that go-go phase is going to be aggressively drawing down that corporate investment account. Now, again, when you hit retirement, doesn't matter what age that is, that corporation, that corporate investment account, the easiest terms to think is it's much like an RSP. When you pull money out of the RSP personally, it's taxable income. When you pull money out of your corporation, it's taxable income. It comes through dividends, taxed a little bit differently, but essentially that's the easiest way to think about it. If you're kind of confused of like, how does this work down the road? Just think, as I pull money out of there personally, it's going to be taxed much like your RSP. Along the way, you're going to build up two notional accounts investing. You're going to build up that CDA account as you have capital gains in your corporation. Talk to your accountant about this. If you have a corporation, and especially if you start investing within your corporation, make sure you have a good accountant, and they will track two accounts: your CDA account, your capital dividend account, and RDTOH, refundable dividend tax on hand. And I won't get into what that is here, but these are two nominal accounts that will help kind of offset some of the tax burden when you start pulling some of that investment money out of your corporation. One of the other big benefits, and I would say this is the third benefit. So first benefit is the initial tax deferral. The second one is the ability to kind of pay yourself down the road, so defer some of your pay. The third one is a big one. That's when you hit 65. Within a corporation, you can split that income with your spouse. So let's say this is your corporation, your spouse or partner has nothing to do with this. If you pull money out of there prior to 65, it's taxed in your hands. Unless your spouse or common law partner is active in the business and has ownership and has reason to collect that dividend, then it can't be taxed to them. But once you hit age 65, even if your spouse or common law partner had nothing to do with the business, you can income split, much like you can as a retiree with other types of income. So it's a great tax deferral and then income splitting and tax reducing strategy when you get into retirement. The fourth benefit of having some investments and built up cash within your corporation is estate planning. And I won't go too far into this, but for us, my wife and I, we will use this as a bit of an estate planning tool in helping kind of pass that wealth to the next generation and future generations. And we do that through life insurance. So we buy whole life insurance. And again, someone wrote a comment on one of my videos just the other day that said, Adam, I find it tough to follow you now that I know that you're a big proponent to whole life insurance. And that's the furthest thing from the truth. In fact, I think whole life insurance is very, for the very small percentage of people. Like, most people should not have whole life insurance. But that small percentage of people that should, based on your situation, it can make a ton of sense. So am I a big proponent to whole life insurance? No, absolutely not. I think term insurance does it for 99% of the people. But for the small percentage of people that have a corporation, that have certain situations, big tax bills on death, whole life insurance can be a great tool. And it can be a great estate planning tool or a tax payment. If you have a big tax bill on death, you might have rental properties or company or whatever it is, a whole life policy can make a whole lot of sense. And I'm going to do a future video on whole life insurance. So I'm planning that out right now. I'm kind of mapping it out to make sure that I can communicate that clearly to you all. But I will say this, we have a whole life policy within our corporation. We pay into it every year, and a whole life policy can be used to kind of build wealth and defer that tax bill, pass it on tax-free to the next generation. And it's really one of the ways to avoid that tax bill on a lot of that asset in the corporation for down the road. And I'll cover that in the whole life video coming up. But again, leave money in your corporation. If you're sitting there saying, Adam, I have extra money in my corp, I'm not sure if I should pull it out or leave it. Look, my personal strategy, and this is years and years of research and just knowing how it all works, is I pay myself enough to pay our bills, put food on the table. I pay myself enough to top up my RSPs and my TFSAs every year. So those are two accounts, and a lot of people say, if you're a business owner, you shouldn't do RSPs. I disagree. I also pay myself a salary. I pay into CPP. I think there's a huge benefit there. Again, a lot of people will push back on me on that. I've run the numbers. It works for me, and I think it works for the majority of people. I think a lot of people haven't run the numbers. And again, I always say, I'm a numbers guy. I put it into our software. I compare apples to apples, and whatever comes out ahead If it makes sense, then I will run forward with that. And so I pay myself a salary and then some dividends, but I top up my RSP every year and top up my TFSA every year. If I have extra money in my corporation, I'd leave it in there. I'd rather pay that 12% corporate tax rate, have a bit more to invest from day one, and let that grow going forward. Now, I know a lot of you are going to say, oh, Adam, lucky you have extra money. I know it's a fortunate situation for some business owners. Being a business owner, you might have really good years and really bad years. And I've been through that. I've been through both sides of it. That's the other benefit and reason to leave some money in your corporation. If you have a bad year, a losing year, there's a bit of a buffer there to support that business. So there's a lot that goes into this, but definitely deferring some of that money in your corporation, pay that corporate tax rate, invest that money. If you have more than you know you need going forward, start investing it, make it work for you. You can invest in ETFs and stocks and real estate. There's a lot of different investments that you can invest in within the corporation, and people don't realize that. So make sure you get that money working for you, get it working for you inside your corporation, defer that tax bill, allow some future income to come out of it, maybe income splitting to come out of it, and you'll be much further ahead. So hopefully this video helped you out. If you have a corporation, if you have some more questions around that, feel free to leave a comment below or send me an email. Always happy to help out with that. So thank you for joining us in this video. We'll see you in the next one.